Hi, it's been a while since my last post. But to be honest, I had nothing critical to say, and I've learned that when you have nothing to say, it's better not to say it at all. But the banking crisis has built up over the course of this year, and it's created a conundrum because, on the one hand, we hear talk of a banking crisis, but on the other hand, the market seems to be pretty unfazed about the whole thing. In fact, this crisis had its beginnings in Silicon Valley Bank's collapse in March of 2023. And what shocked people was not just the magnitude of the collapse, but how quickly it happened. I mean, that failure was followed by Signature Bank later in that month, and then Credit Suisse in April of 2023, and First Republic last week. Now, as these banks have fallen, and these are all pretty large banks, collectively these banks have more deposits than the banks that collapsed in 2008. But unlike 2008, the market seems to be doing relatively well. The word that I've seen described for the market is resilient. It's not like banking stocks haven't suffered, but it seems to be more restricted to just banking. The question of what's going on, whether this crisis has more to go, whether there are more dominoes to fall, and what the implications of a banking overall as a business is a questions I'm sure are pretty much in everyone's minds. And I'm going to try to answer them. And I'll be quite honest up front. I am not a banking expert. I'm a dabbler in banking. There's more I don't know about banking than I do. So if I reveal my ignorance, forgive me. But let me get going anyway. When I think of a bank, and I'm thinking of a typical traditional bank, and I try to break its business model down, the model starts with taking in deposits. Customers come in, they deposit their cash with you. Why? Because you offer them convenience, you offer them trust, and you offer them safety. Sometimes you offer them an interest rate. So some of these deposits are demand deposits where you don't pay interest and they can take them out at any time, checking accounts. Some are interest rate bearing deposits with terms attached to them where people can still take out money, but there might be a penalty. So the business gets started with deposits. Now, what do banks do with deposits? Well, they take those deposits and loan them out to individuals, to businesses, charge an interest rate that's high enough to cover the default risk. Here's high enough to cover the default risk on those loans. And that interest becomes income to the bank. Increasingly, banks also have the option of investing those deposits in marketable securities, in investable securities. Usually fixed rate securities, bonds, and those bonds can range from treasury bonds to corporate bonds to mortgage-backed securities of relatively high rating or low rating if you choose to, and you make interest income on those securities. So you take in deposits on which you might pay interest on some of those deposits, and you put that money into loans and investment securities, and you earn money. That spread between what you earn as interest and what you pay out to your depositors becomes the key driving force for income at banks, because from that spread you have to cover any defaults on your loans, any losses on investment securities, and whatever's left is yours as the owner of the bank. Now, to the extent that banking is subject to shocks where you get unexpected losses, you build up an equity capital to cover those losses. So far I haven't introduced a regulator because banks predate regulators. The purpose of having equity capital is to provide a buffer against those losses. Now, if you look at this picture, I've also given some key metrics you might want to look at when you look at a bank. When you look at deposits, for instance, you want to look at the percentage of deposits that are non-interest bearing, because those are the best deposits to have as a bank. You also want to look at the average interest rate banks pay on those deposits and the percentage of deposits that are very large deposits. Why? Because at least in theory, deposits up to 250,000 are insured, and above 250,000 you're on your own. Though that's more in theory than in practice, but those are numbers you want to know about your deposits. Big deposits, the percentage of total deposits. When you look at loans, you want to see the interest rate you charge on those loans. You also want to know something about the default risk of the borrowers, because you want to make sure the interest rate you charge is high enough to cover the default risk. On your investment securities, you want to know about what you earn as an interest on those securities, what the average maturity of these securities are, they short-term or long-term, and to the extent that you're investing in securities where there's default risk, how much default risk there is. And finally, if you look at equity, you want to look at equity as a percentage of your total assets. How much buffer have you built in? And as we would see in the next page, as regulators have stepped into the game, how that equity plays out in regulatory capital, and that regulatory capital as it measures up to how regulators measures assets, called risk-weighted assets. So in general, when you look at a bank, you're looking at a very, very unique institution. At some level, it's a very simple model, and the value drivers are pretty easy to see. Now, of course, you're saying, where do regulators enter this game? Now, remember, as I said, until for much of the life of banking, and banking has been around as long as business has been around, it was unregulated. What does that mean? Banks self-regulated. Some banks set aside enough equity capital to cover downturns, but others didn't, which meant that bank runs were routine through much of the 16th, 17th, 18th, even the 19th century. It was only in the aftermath of the Civil War that in the US you started to see bank regulation, and each round of regulation was triggered by a crisis. The banking regulation in 1860, the banking rules that were passed in 1863 required chartering of banks for the first time and introduced the notion of safety reserves, regulatory capital. The 2007 banking crisis, made legendary by the fact that JP Morgan saved the US, in many ways triggered the creation of the Federal Reserve in 2013. The reasoning being you couldn't put your fate in the hands of private bankers. The Great Depression gave rise to the Glass-Steagall Act, and essentially the Glass-Steagall Act restricted banks from taking deposit money and doing risky stuff from it. People often think of it as just investment banking, but pre-Great Depression, banks could be equity investors in companies. They could be venture capitalists. Those were taken off the table, so the Glass-Steagall kind of restricted banks to banking. Those Glass-Steagall rules over time have been loosened, but in the 1980s, the Basel Accords, where G10 countries got together, globalized and formalized the regulation of banks by creating this notion of risk-weighted or risk-adjusted assets, where essentially the asset base was adjusted for the riskiness of the assets. The intuition being banks with riskier loans, riskier investments needed to hold more capital. And it also introduced the notion of Tier 1 capital composed of equity and equity-like instruments. Equity-like is a fuzzy word, and basically it's any security with just a residual claim, in a sense can qualify as Tier 1 capital. And ratios were required. And as part of the regulatory push, the regulators were given punitive powers. In other words, if you were a bank that wasn't in the highest rating in terms of being safely capitalized, the regulators could restrict how much executives got paid and even how much you paid in dividends. And if you fell below a safety threshold, regulators could step in and shut you down. Now, finally, the 2008 crisis created its own consequences, because one of the problems with Basel is it created this fairly unhealthy process where banks decided that rather than running themselves to be safe banks that could last in the long term, they wanted to play the regulatory capital game. What is that game? You want to take on risky investments, but do it in such a way that the regulators didn't recognize the risk in those investments, either because the investments were complex or because they were new. And when you borrowed money, in other words, you took on non-equity, you wanted to clothe it to make it look like equity. So for years, banks decided that they could beat the regulatory capital measures at their own game. And in 2008, that game blew up. And in the aftermath of that crisis, you had the Troubled Asset Relief Program, which is basically a bailout program for the biggest banks, which had faced significant losses on their mortgage-backed securities. So the TARP, as it was called, invested about $426 billion in bank stocks and mortgage-backed securities at the largest banks. Every regulatory action has consequences. That TARP action by banks made it quite clear that some banks were too large to fail, and it might have put the seeds in for what you're seeing in 2023 play out at banks. So let's talk a little bit about looking at the banking business, what separates good banks from bad banks. Again, my understanding of banking is simplistic, so I'm going to keep it simplistic. When you look at deposits, in a good bank, a high percentage of the deposits are non-interest bearing. Why? Because it allows the bank to have access to essentially free capital. And to the extent that a lot of bad deposits are non-interest bearing, the interest rate paid on deposits is a low number. In addition, good banks have sticky deposits. What does that mean? Your deposits stay with you. They don't easily leave you for a variety of reasons. The depositors have been around a long time, but in effect, these depositors are slow to pull out of the bank or move their money to interest-bearing accounts. So good banks have lots of non-interest bearing deposits, pay a low interest rate on those deposits, and have sticky deposits. Bad banks have much more of their deposits as interest-bearing deposits. They often pay high interest rates on those deposits. And I don't know what the opposite of sticky deposits is, but let's call it sensitive deposits, where depositors pull their money out quickly in response to rumors or move their money quickly in interest-bearing accounts. Good banks, if you look at the regulatory capital, have lots of equity relative to total assets. And you think in regulatory terms, have a big buffer built in. So they're not just meeting regulatory minimums, they have a buffer built in. Bad banks, on the other hand, skate at the very margins. They have much less book equity. They have low tier 1 capital, and some of them are gaming the regulatory capital system. In other words, their true regulatory capital is even lower than what's reported. On the loan front, good banks have a diverse mix of borrowers. They're not lending to the same type of borrowers. Get an interest rate in the borrowers that is reflective of their default risk. Notice I didn't say they lend to safe borrowers. You could be a good bank that lends to risky borrowers as long as you charge them a high enough interest rate. And they build in enough of a buffer in their interest rates against the defaults that'll come around at some point in time or the other. Bad banks often have concentrated borrower bases and lend to the same kind of borrowers, so when they get into trouble, they all collectively get into trouble. Their interest rates are low relative to the default risk. It's not just the level of rates. So they might be lending at 7%, but if you're lending to borrowers where you should be charging 9%, it's not enough money. And finally, they have minimal or no buffers against loan losses. Finally, on investment securities, good banks match up the duration of the investment securities to the duration of their deposits. Your deposits are short-term, your investment securities are also short-term. It's banking 101. It goes back as long as banking has been around. You have a high percentage of your investment securities marked to market. What does that mean? If you have losses, you mark to market, everybody knows. Now, it creates transparency, and you invest in securities with high liquidity. What do bad banks have? They have mismatches. They borrow long-term with short-term deposits. A low percentage are mark-to-market. That's an accounting choice, and it turns out that banks have a loophole. On investment securities, if you classify investments as held to maturity, you don't have to mark-to-market. That's going to be at the heart of the stories we're going to tell about what happened in 2023. And sometimes bad banks invest in securities that are less liquid, so it's tough to get out without taking losses. Now, I know this seems a little extreme, but not every bank has all of the good features, and not every bad bank has all of the bad features. You're looking at the mix in a bank and trying to make a judgment on good or bad. Now, even if banks are bad, people often don't notice it. And when I say people, investors, analysts, even regulators in the good times. It almost always takes a macro crisis of some sort for people to notice that banks are in trouble, that you've got bad banks. One, of course, is recession. Through the history of banking, when recessions come around, they test banks. Why? Because more people default collectively across the board, and the banks that have not built enough buffers get into trouble. On this front, you could argue regulatory capital does pretty well because you have history that you've learned over. So when you look at the capital ratios set for banks, they are good at dealing with recessions. What are they not that good at? Well, in theory, banks should lend money against a borrower's earnings capacity. You think that's pretty obvious, that's what they should do, but that's not what banks usually do. Banks often lend against the value of assets rather than the earning power of the assets. The rationale being, if we get into trouble, we can sell the asset, get the money back. Not realizing that to a bank, having to sell assets to get your money back is an admission of failure as a bank. But there's a bigger problem. If an asset class you're lending against gets overvalued and you lend against the prices of assets, when the correction comes, as it almost always will, you're going to be exposed as banks. In many ways, 2008 was a crisis created by banks lending against overpriced housing, and when housing prices corrected, banks broke down, so overvalued asset classes. Neither of these really applies in 2023, right? We don't have a recession. I don't think banks have collectively lent against overvalued asset classes as much. But this particular crisis has been created by rising interest rates. 2022 was an uncommonly active year for interest rates. The T-bond rate during the course of the year went from 1.51% to 3.88%. That's a seismic move for a T-bond rate. How does it play out? The 10-year T-bond lost almost 19% of its value in 2022. A 10-year corporate bond, a BAA rated corporate bond, lost almost 27% of its value. What does that mean? If a bank had invested in T-bonds, 10-year T-bonds in 2021 and early 2022, those bonds would be worth about 20% less than they were at the start of the year. That's an uncommonly large hit you're going to take. So when you think about interest rates and how they play out at a bank, let's start with the bad stuff. Your loans collectively are going to be worth more. Longer term loans will have to be marked down less for the same reason that bonds get marked down, because those loans have fixed rates. Now rates have risen, those loans become less valuable. So both loans and investment securities become less valuable as rates rise. Now sometimes those losses might be shown on the books, but only sometimes. With loans, they almost never get shown because you don't have to mark to market. And with investment securities, they get shown only for those banks that don't classify them as held to maturity. So clearly there's a hit that banks take on the asset side. But there's a benefit banks get from rising rates as well. Remember that deposit base? A lot of it is non-interest bearing. When you're paying 0% interest rates or 1% interest rates and market interest rates start to rise to 4 or 5%, your deposits become a gift that keeps on giving. In other words, the benefits of having a low interest rate or a non-interest bearing deposit becomes much greater when interest rates are high. The net effect is what's going to determine how interest rate rises affect banks. So generically, you'd expect banks with more non-interest bearing deposits and shorter term loans and investment securities to be less affected, less negatively affected by rising rates, perhaps even benefit from rising rates. In contrast, a bank which has a lot of interest-bearing deposits that are marked to market and assets and loans that are long-term, which are mismatched to those deposits, will see a much bigger hit to their value. So with that lead in, let's talk about a few of the failures in 2023 and look for some common patterns. What is it that ties these failures together? Let me start with Silicon Valley Bank. To understand why Silicon Valley Bank became the problem that it was, we have to go back in time. This is a bank that's been around a long time that decided it was going to go after a niche market, which is Silicon Valley in all of its different forms, VCs, founders, employees at startups, and essentially make its business model built around Silicon Valley. The good news was that niche grew at an incredible rate in the last decade, and Silicon Valley grew. And Silicon Valley Bank grew with Silicon Valley. But remember, your clientele now is all Silicon Valley based. They all know each other. They're virally connected. And this is now going to become part of the story as you see 2023 unfold. Now, one of the things that happened in 2021 was venture capital investments dried up, but funding coming into venture capital continued. So the cash that venture capital had available to it started rising. You had billions of dollars accumulating in VCs that couldn't find a place to invest. So guess where it went? It went to Silicon Valley Bank as deposits. In 2021, the deposits at Silicon Valley Bank almost doubled. That's an almost unprecedented jump in deposits at the bank. And that doubling of deposits created a problem for Silicon Valley. All this money was coming into Silicon Valley. You're saying, why did they just make it out as loans? Well, the loans Silicon Valley makes are venture capital debt. Venture debt is unique. It's a very unusual debt. It's not backed up by the earnings power of companies, because the companies you give the debt to are often pre-earnings companies or money-losing companies. It's backed up by the expectation that there'll be future VC rounds that bring in cash that allow the payment of the debt. So venture debt works well in rising markets where young companies are becoming more valuable over time. But remember why venture capital was putting all this money into Silicon Valley Bank. The venture capital business was under threat. Risk capital was pulling to the sidelines. There were more down rounds. Venture capital was not as willing to invest in companies, so venture debt was not growing. So you had all this money come in. There's not much opportunity for you to put into venture debt. So where does it go? Silicon Valley Bank invested it in long-term bonds, T-bonds, and safe mortgage-backed securities. Now, that choice of investing in investable securities was probably out of their hands. What else could they do? But they made the choice to invest in longer-term securities for a simple reason. At the time they made these investments in 2021 and 2022, investing in short-term treasuries, T-bills, or commercial paper was earning almost no interest. So effectively, they'd have taken in deposits at no interest, put it into investment securities at no interest. You were making no money. So they decided to take those deposits and put them into T-bonds, earning only about 1.5% to 2%, but that was more than 0%. And they sprung a trap for themselves. Because as you saw in 2022, T-bonds collapsed in price. And Silicon Valley Bank had almost 60% of its assets in treasuries and mortgage-backed securities. It was more exposed than the typical company, those investment securities. Most of them were held to maturity, so people didn't notice the damage that was occurring in those securities. But Silicon Valley Bank knew that they were in trouble, that those securities would have to get marked down. In fact, what they did to try to protect themselves against markdown is what triggered the meltdown, because they went out and decided they're going to actually sell some of those securities, take a loss, and simultaneously issue equity. Very textbook fix for the problem to cover those losses. And that was the plan. The plan leaked. And who did it leak to? To the most virally connected depositor base in history. Everybody in Silicon Valley talks to everybody else. They're on their phones all the time. So it leaked, and within 24 hours, there was a run on the bank, an old-fashioned run where people pulled their deposits out because the clientele that Silicon Valley Bank had were not only virally connected, they were uniquely positioned to be able to move money quickly. The bank melted down. So its very success created the seeds for the failure that came about at Silicon Valley Bank. Now you're saying, what about Signature and First Republic? What did they share in common? With Signature Bank, the key feature seemed to be the percentage of deposits that were uninsured. The bank had a lot of big deposits. It had also dabbled in crypto, and it had already been labeled by the FDIC as a bank of concern because of poor management and because of failure to respond to regulatory requests for information. So Signature Bank was already on that red list, and when the run started, the FDIC moved really fast and shut it down. But the key was deposits were starting to leave very quickly from Signature Bank. What about First Republic? First Republic's most characteristic feature was a big wealth management business where they catered to really wealthy clientele. And many of those wealthy clientele deposited their money at First Republic Bank. They got all kinds of side goodies, small goodies, but goodies anyway. Many of these depositors had deposits exceeding $250,000. And when you have a lot of wealthy depositors, the upside is you don't have to work as hard to build up your depositor base. The downside is when there are rumors of trouble, these are exactly the kind of depositors who are going to withdraw money quickly and move it elsewhere. And in the first quarter of 2023, and this came out in the earnings report, the bank lost almost 41% of its deposits. As I look across these three banks and look for commonalities, I think the commonality is that they all had deposit bases that were not sticky. They had commonalities in terms of some of the investments having to be written down, but the most common feature is they seem to have non-sticky deposits or sensitive deposits as I described them. So as we look forward and you look at what we can get out of this and perhaps look to see where the next potential target for these people targeting banks might be, one thing we might want to look at is deposit stickiness. As I said, I know nothing about banking theory. I'm sure there's a huge amount of research done in this. But as I look at it as a novice, when I look at what drives deposit stickiness, there are 4 characteristics that I can see that will make some bank deposits more sticky than others. The first is depositor characteristics. Younger depositors, wealthier depositors are less sticky than older and poorer depositors. Second is the age of the deposits themselves. The longer a deposit has been with a bank, the less likely it is to leave. Now, I don't know, user-based companies have tables called cohort tables, where they tell you what customers have been around 5 years do, which is different from customers who've been around 1 year. Maybe banks should be preparing deposit cohort tables where they show deposits by age and the stickiness by age, what percentage of deposits get withdrawn by age. The third is deposit growth. Banks are not equipped to deal with 80% or 100% growth in deposits. You saw what happened at Silicon Valley Bank. I would argue that faster growing banks in terms of deposits have less sticky deposits than banks that are more mature and have slower growth. And finally, I think to the extent that the deposits of a bank are concentrated in a particular region or are more exposed to deposit runs simply because of that concentration, that would make regional banks have less sticky deposits than more national banks. So, having laid that groundwork, let's see how 2023 has played out. Lots of headlines about banks in trouble in a banking crisis, the overall market unfazed. The S&P 500 actually is up 6.5% for the year. Now, in this graph, I actually have 4 S&P indices to show how the pain has kind of been isolated to banks. If you look at the S&P Financials and Real Estate Index, there's a drop, but the drop is so. This is not something that's showing up in housing prices yet. So it's down 6%, which is worse than the overall market, but it's only 6%. If you look at banks in particular, the index is down. That index is down 26%. If you look at regional banks, it's down about 35%. I mean, how would I read this graph? Basically, at least for so far in 2023, this banking crisis has inflicted pain on banks in general and regional banks in particular. Now, of course, there is this, I've heard people say this, that the big banks are gaining at the expense of small banks. So I thought going in, when I did this graph, that I would see much bigger losses in percentage terms, market cap losses in percentage terms at small banks than at big banks. But that doesn't seem to be the case. Here I've classified all US banks, and there's some very small banks in here as well, publicly traded banks, into 10 market cap deciles. You can make your own judgment, but if you look at the biggest percentage changes in market cap, it's not in the smallest banks, which are to the left, it's in the biggest banks. It's true the largest decile is down only 19%, but the worst performing banks are in the 8th and the 9th decile. I mean, that doesn't surprise me, because if you look at the 3 banks that failed, Silicon Valley Bank, Signature Bank, and First Republic, none of them were small banks. They were all banks of large magnitude. So this notion that big banks are somehow benefiting at the expense of small banks, I think is based more on anecdotal evidence. Maybe JP Morgan is your anecdotal evidence, but collectively, I don't see that. So I'm curious, and I'm just starting to explore this process to see what it is that it can explain why some banks are being punished more than others. And I latched on to this deposit stickiness. And I must confess, I don't have a lot of the data I'd like to have to classify deposits on stickiness. I don't know depositor age at banks. I don't know deposit age at banks. I mean, there are lots of things I don't know, but I do know what deposit growth has been at banks. So what I did was I classified US banks into 10 deciles based upon the annual percentage growth in deposits between 2017 and 2022. So the banks to the right are the highest growth banks. Banks to the left are the lowest growth banks. And this graph is pretty striking. It's the highest growth banks that have seen big drops in value. In fact, you take the top 5 deciles, they've lost about 28% of market cap. You look at the lowest growth deciles, the drop is much lower. It's about 8%. Now again, there's a correlation between growth and size of banks, maybe deposit size, maybe there are other things going on. But I think deposit stickiness is the big story in this banking crisis. So what does this all mean for the future? I think 2023 will continue a consolidation we've seen in US banks, not just for the last few decades, but over the last century. If you go back to 1984, there were about 14,000 plus banks in the US. That's down to 4,800 in 2023. And you're going to see more consolidation as you go through. Will we end up with just 8 big banks? I don't think there'll be that much consolidation, but there will be consolidation. Now, some people view that consolidation as a potential danger. They say, look, banks consolidate. There are only 8 big banks. They're going to charge us prices we can't afford to pay this. So the implicit story is banks are going to become, the consolidated banks are somehow going to behave like monopolies and make more profits. I may be naive, but I don't see that happening. I think banks are going to continue to struggle with profitability, because the disruptors essentially come and eat away at the easiest and softest businesses, often the most profitable businesses. I think that will continue. In fact, I think one reason we're seeing the consolidation is because fintech has disrupted banking and taken the easy banking business away. Third, I think accounting rules will change, as always after a crisis. SVB, I think, will be used as an example to illustrate why banks should not be allowed to use the held to maturity categorization as easily as they have been allowed to put their investment securities into that group and not have them mark to market. I don't think you're going to see a jump to everything's got to be mark to market, because that comes with its own set of dangers. But I do think the rules on what gets marked to market will get tighter. And finally, I think that there are going to be regulatory changes coming. As I see it, 2023 highlighted 2 limits with the way regulators look at banks. One is not enough attention is paid to duration mismatches at banks. It might be part of the regulatory framework, but it needs to be it needs to be a much bigger part of regulatory coverage. Banks like SVB, which have 60% of money invested in investment securities and are putting them in 10-year bonds when their deposits are demand deposits, need to be flagged. The other is deposit stickiness. And I think that, again, while regulators might have always thought about this, I think we need to get more explicit measures and data that measure deposit stickiness. I know that it's a Pandora's box, but I think knowing how many Twitter followers your depositors have might be a good indicator of how sticky your deposits are. Banks with depositors who are on social media all the time probably have less sticky deposits, are more in danger of bank runs than banks whose depositors have never opened a Facebook account. I know that's opening a Pandora's box, but I think we need to think more seriously about deposit stickiness. As I said, everything I've said in this session comes from the perspective of somebody from the outside looking at banking. And I'm sure there are banking experts who'll set me right on things that I've misstated. But I thank you very much for listening, and I hope you found this session useful. Take care.